All right. All right, we're recording. So this, what I wanted to talk about is how you profit in what I call an inversion of risk trade using options, using credit spreads. And there's a lot to it. So let me just start with, a lot of people think that putting on real high probability options trades using a low delta, high probability is a good way to make money. Thinking that, man, if I go 90% probability or 95% probability, how can you lose? Well, I mean, the odds are that you will eventually lose. The problem with it is that when you set a profit that's this big, the risk is always commensurate, is like this big. And while you'll win often, and you may win for a long time, eventually you're going to lose. And when you lose, you're going to lose really big. It's going to happen fast before you can do anything about it. You know, you say you'll set stops, but setting stops means that you'll have to set it someplace, and that will effectively take away your 95% probability of win. Brings it way down. And when you lose, you'll still lose big because it will take you out of the trade. There will be no way to come back. Where in options, even if it goes into the losing area, it could come back because you're still in the position. So anyways, high probability trades are not all what they are made up to be. They have caveats with them. A high probability trade has a huge caveat, and that is huge risk. Now, I'd been looking at the zero DTE strategies that are out there, and universally, they're all built around very high probability trades, high probability iron condors or spreads. Now we do these things, we do spreads and iron condors in the 3D options class too, but you'll always notice that I'm trying to get around a 60-70% probability, so that there's a good chunk of potential profit, but the risk is okay, it's palatable, and it gives us enough time to be able to adjust the trade, or the premium is decaying at a sufficient rate. With low probability trades, the premium decays very slowly, and that's because within a given certain time frame, time is moving on from boom, 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 boom until it comes down to nothing, right? If you have, say, this much profit, right, as time is moving on, it can seem like a slow crawl as time is moving on because you're not really gaining a lot with that much profit. But if you have this much profit as time is moving on, with each chunk of time, you're gaining a lot of the amount of premium that you're collecting or bringing in is a lot more. I don't know if that makes sense the way I did that when you look at it in those two dimensions. So there's obviously a balance between the probability of profiting and then the return on capital that you make. Now, there are ways to construct a trade where you put the big kahuna part of the trade deep in the money, right? So you don't make anything until the price moves far enough to go into that deep in the money situation. And I'm going to show you an example of that right now. And hopefully you'll be able to see this. All right. Oh, I can open the original. Can I bring that over there? I think I can. All right. So here is a deep in the money call spread, actually a put spread, right? Where I put it on and price is right in the middle of this gray area when I put the trade on. And so that means that price has to move up until we get into the profitable zone. However, the cyan line, that's only the profit at expiration, right? The real profit at any one time is the purple line. That's the real value of the option. So while I'm moving to the right, I can still make money. And the contract, I could sell the contract to somebody else for more than I took in. So let's say I entered the trade right here, but then at some point price kept on going down and well, let's say I didn't enter the trade. Let's say I put the trade on here, but I said, look, I want to take on more credit than I can even get here. So I say price has to go down 20 points before I will enter the trade. So price would come down here, get into the trade, giving me only maybe $35 worth of risk. Now I'm in this trade. Now, any amount of movement that the price makes to the right is all profit up until the expiration. Now, during the day, I might move, 20, 30 points closer to my profit tent here. And while if this were expiration, it wouldn't be worth anything because there's plenty of time left. That T0 or that purple line has increased. So the value of that contract is more than what I paid for it. So I could then conceivably sell it at that point for more money. Now here's the cool part. Now let's say that I put on this trade in such a way that there's $25 of risk, but $250 worth of profit potential, right? Now I put it on, I have $25 of risk and it moves up so that now I can, if I wanted to sell it, I could sell it for $25. Well, what is that return? Well, I have $25 of risk and I return with $25 of profit. That's 100% return on my risk. If you can make 100% return on your risk every time, you're doing something. You're doing something very special, right? Let's say it goes up another 20 points and now it's worth $50. I could then, and in the S&P, it moves like that all the time, especially now that we'll get this big dip in the pre-market, and then it will, like gangbusters, start going and trending the whole day, and then gain like 60, 70, 100, 120 points. Well, during that time, if I put this on early enough, I could profit at any time during the day. I could put on 2 or 3 of these, and maybe I could take a couple at 100% profit, maybe one at 150% profit, and then leave one on and see if it will go all the way. Because I've already made 4 times my money that I was risking, and now I have one left that might go all the way. So I'll just let it go. If it loses and never reaches there and then becomes worthless, then okay, I lost $25, but I made 75. Does this make sense to you guys? So when the way you do it is you project out, you say, look, I think price is going to move this much. And so really by default, you're putting something way deep in the money. And you may ask, well, am I worried about being deep in the money? Won't I get assigned? The answer is the chance of getting assigned is very, very low. And even if you do get assigned with, let's say you're using something like the E-mini S&P futures, your broker is going to offset it with the long contract, and it'll just be a wash. You won't get charged anything, or just the difference, which would be your $25 risk. So assignment is not a problem. And if you use the SPX, it's definitely not a problem because they settle everything in cash. And with the futures, they essentially settle it in cash. It's just that the broker has to close the trade for you and sell it on the market. which they do right away, and sometimes you even make out. You might make a little bit of money. So getting assigned is not a problem. The only thing that you're trying to do in a situation like this, let's see if I can bring up Think a Swim. Just going to bring up the E-mini. All right. Because the March contract expires tomorrow, there's only one more E-mini left here for tomorrow, March 21st. So let's say that I'm anticipating that price. Now, we could either anticipate the price is going to go up or it's going to go down. If it's going to go up, I'm going to put on a put spread. If it's going to go down, I'm going to put on a call spread. So right now we're sitting on the S&P at about 39.30. Let's say I anticipate that we're going to go up to 39.70. Well, I could create a vertical for that. And I'll go to the risk profile and see what that looks like. It's more contracts than I want, so I'm going to bring it down to one contract just to make it easy to talk about. All right, so here I am with this trade that if I get into it right now, and from where I am, if price went up at all tomorrow, I have a darn good chance of profiting, because that T0 line, the purple line, is like going up at a 30, 40 degree angle here, which means if I go to the right at all with price, I'm gaining money. So you can see it when I drag across. There's $72 profit. There's $135 profit. If we go all the way in, the potential is that I'm making up to $212 profit. But the risk on my trade, all right, the credit is going nuts right now. Let's say that this is the risk on my trade, and I've just fixed it, is only like $35, but I could make as high as 215. Now I could choose to try to get in and get more credit. Let's say I tried to get, like, I can usually get $4.50 of credit, which means that will give me about $25 risk. Sometimes it's possible that you put a trade like this on and you could wait until you only get $5 of credit. I've done that before because you anticipate that price is going to go down, then go up, which it always does in the S&P, at least during this QE stuff. It's conceivable that, and I have gotten as much as $4.75 of credit, which is a cost or risk of $12.50 on my trade, and a potential profit of $237. That's like 15 times my risk. All right. So now if I get into the trade, sure, price could go down, right? Price could go down from now until the expiration tomorrow, but I'm only risking $12.50. What do I care? If price goes up at all, I can sell that contract at any point. And of course, when the market is open with that real money, the T0 line won't be jumping all over the place. It'll be nice and steady going up. I can sell that at any point. Let's say it goes up a little. All right, I could probably make, double my money or triple my money, which is a small amount. Or it could go up, say, 30, 40 points, and I could quadruple or pentuple my money. All right, so instead of, so I risk 12 and I make 50. It's 4 times my money. I hope you're seeing the value in this. Now, of course, time is working against you. And this is really for what I would consider relatively volatile markets, and also markets that you can more or less anticipate where price is going and what the kind of average move is. And that's been pretty predictable on the S&P for the past year, for the past 10 years. It's been mostly going up. Occasionally it goes down. But you could make this trade every day and do 100% return on your money like clockwork. It's when you start getting a little bit more greedy, and maybe some days you'll get into a trending market where it will just keep on going up. You don't have to do anything, and you can tell it's a trending market. Like yesterday was a trending market, but it didn't go quite as high as I needed to go. It was short by 10 points. If it had gone another 10 points, I would have been in the money with one of my contracts and made $225 off of a $25 risk. So you can tell when there's going to be a trending market early in the day, and whether or not you're going to just hold out for the big win, or you're just going to wait for it to go up and make 100%, 200% on your money and then get out. So I know there's only 4 of you there, but does this make sense to you, to anybody that's out there? Please, respond. Respond. Thank you. Thank you very much. All right. So I'm glad this makes sense, because, I'm not anticipating that I'm going to make a lot of money. I am really just going. Now, you could do this every day or every time you have it and try to go for that 100% on your money bet. And you're going to be right probably 80% of the time. All right. Unless the market goes down. Then you only risk a little bit. And then every once in a while, you're going to get a trending market, and you'll just leave it on. And you'll be able to tell whether or not it's going to reach your objectives, because it will either go up there right away or it will be moving up like that all day. And you'll be able to tell whether or not you can let it go all the way, or if you want to cut it short just before the big kahuna and at least take a healthy profit. The other part about this is, if it goes the other way, you don't care, because it's not a lot, you're not risking a lot. So the trade, you're never in a situation where you're sweating the details, right? You might be anticipating making a lot of money versus making a little money. And if that's the kind of anxiety that you want in your trading, that's a good kind of anxiety rather than losing a lot of money. Could you pull out daily ES market direction call? Could you put out? No. I don't know which way the market's going to go. Is this strategy mostly for a bull market? It's for whatever market, wherever you think price is going. Because I can do the same kind of anticipation, maybe not at such a difference or a ratio. Maybe instead of 1 to 10, I can do a 1 to 5 market pretty easily in most markets. And I would use volume profile and the trend to choose whether or not I want to be, and also the average true range, which is telling me on average on a daily basis how much a stock is going to move up and down. And I could adjust my trade according to that. And I could put on both long and short trades, right? If I think that it's going to be a relatively volatile market, I'll put on both long and short in kind of a long straddle. So you can make money at this with relatively little risk, particularly in a relatively volatile market like the E-mini. You could also do it in other things. There are plenty of other asset classes out there that have The thing that's so attractive about the E-mini is that you can do this 3 times a week. All right. So it could be a bull market or it could be a bear market. Now, bull markets, as you know, we've had a bull market for forever. For some people, it's been a bull market ever since they started trading. It's been their entire career, and they could have had a career for 10 years. We're in a bull market. You can do this almost every day. And the days you can't, you can pretty much tell. So the really cool part about this is that you can do this in the futures, and you could even trade around it during the day and add to it or whatever if you wanted to. But that's a little bit more than I wanted to go over. But you could do this 3 times a week. And with futures, you don't have to worry about ever running into the pattern day trader rule, because you could put this trade on, take it off, and then you could conceivably put it on again and take it off in the same day, or you could do it on the Wednesday and the Friday, and then the next Monday, and you'll never hit the pattern day trader rule because it doesn't count. It doesn't apply to futures contracts. So VM, it's not mostly for a bull market. It's for any trending market, and we're in a trending market, right? I don't know if there's any other way to describe this market other than it goes up, right? It goes up, except for, every, I don't know, 15 or 20 days, it has a slight bump down, and then it goes up again. That's about it. That's what this market does. And it's been doing it now since, 2009. We had a real big market scare on, last March. But since then, it's gone straight up. Now, I don't know when or if that will ever change. It's almost like they have to keep it going, otherwise they will totally collapse. Yeah, but yeah, and so even if it doesn't, your risk is capped and it's small. It's super small. It's not like regular trades that we put on where you're trying to make $100 and you're risking $400. That's a healthy amount of risk to take, but that's still usually a good trade, or considered a good trade. This is a complete inversion of that, where it's you're trying to make $400 and you're risking $100. And you're not really trying to make the 400. What you're trying to make is an expected move that will give you some fraction of that 400. All right. So that's what I wanted to share. And this would apply. You could do this in the 3D options. You could do this. We could even do this in the asymmetric advisor if we thought we had a clear idea of where we thought prices were going to go over the next, I don't know, year or so, and do a very low probability trade and put the target way in the money and just wait. If price starts going up that way over the next couple of weeks, you'll find yourself with a lot of profit, not as much as you could make, but enough. I mean, if I can make 100%, 200% of my money on most of my trades and risk very small amounts, it seems like a pretty good deal to me. But most people aren't willing to do this, because most people want they're not anticipatory. They're not willing to wait around. They're not willing to. I don't know why. I think that investors, this is how investors invest all the time. They're always looking for the long range goal. And long range can be anything. It can be a day, or it can be a year, or it could be 10 years. Here, I'm just looking at a day, and we're looking at long range. We think that this is going to go up throughout the day. And so we'll just put something on, way lower than we think it's going to be. and then we'll take profit. Depending on the acceleration, we can take profit at any time during that time on its journey upwards. The success rate, 80%, isn't referring to achieving the full profit. It's referring to achieving a partial profit or some of the potential premium that you collect. And that's because of the probability of touch. In other words, price is going to move, right? And in general, in a bull market, it will move in the direction that you want it to go, or a bear market, it will move in the direction you want it to go. And from the point that you put on the trade, say in the morning until the afternoon, price is going to move. It might move all at once in the first hour of the market, or it might take all day for it to move to wherever it's going to go, but it's going to move. And when it moves, it traverses that T0 line, which is a slope, a gradual profit slope up to the the ultimate end goal. If it moves soon enough, you're going to make profit. So it depends on how much you want to make when you consider an 80% success rate. But if I could make at least say 50% or of the amount that I risk, I mean, most people would consider that outrageously good. But I think you can make 100%, 80% of the time. You can make, in other words, you could double the amount that you risk in the amount of profit that you take in about 80% of the time, just based on the average daily range of pricing. And if it happens within, say, the first couple of hours, you're going to make it. If it takes a little bit longer, you might make a little less. Sometimes it will it'll keep you riding along and it doesn't do anything, and then right at the end of the market, it moves the entire amount at the end. In that case, you've really got nothing to lose. You're a loser all day, right? And then all of a sudden, in the last hour, it decides to move the entire amount, and then you end up being a winner. But you don't care. I mean, you don't care as much because you're not risking that much. So I don't want to make it seem like you don't care. What I'm saying is that the risk to reward is so great, or the reward to risk is so great that even if it does nothing all day and you don't even get the chance to make the 100%, you think, well, okay, no big deal. And then at the end of the day, it could conceivably go all the way up, which it does quite a bit. We have these last hour moves that are just insane. So, but most often it will move sometime in the early before noon, and you can either get out, take your profit, or hold on to it and see if it's a really strong trending day, you might want to hold on to it. Most of the days that I've encountered are days that, after the European Open, the market drops dramatically, and then 8 o'clock it starts rising. If you're in before 8 o'clock, and with these options, you could definitely do that because you don't have to wait for the cash market to open. You could be out with 150, 200% profit before 10:30. I would say most often you're going to probably make 50 to 75% to 100%, right in that range. But still, those are good returns. So that's it. That's everything I wanted to present. I hope this was useful and kind of eye-opening, that it's kind of unconventional, but like I said, you're just banking on a probability of touch based on the average true range and the direction of the market and basically what's happening that day. Now, I waited yesterday and it didn't do anything until 2 o'clock, but I was anticipating the Fed was going to be on at 2, and I didn't know if price was going to go up or down, but I figured in this market it's probably going to go up. So at 2 o'clock and just 2 minutes after that, I made 100% profit in like 2 minutes. It was a loser all the way up until 2 o'clock, and then at 2 o'clock the price jumped way up and made my trade profitable. Actually, 2 trades. One was 140% profitable, and the other one was 200% profitable. Of course, that was a slightly special day, so that's not going to happen every day. Usually it's a more gradual thing during the day. All right. Hopefully this was useful. I'm going to say goodbye now. I hope you have a great rest of the day. Take care.